Hello and welcome. Today we will be discussing deep value investing, investing in stocks that are trading at a significant discount versus their intrinsic value that maybe have been unfairly priced by the market, but that offer great rebound potential. And to discuss this in the ASEAN region, I am joined by David O'Neill, who is the co-founder of the Asean Investment Management firm, which is a hedge fund that focuses on deep value investing in ASEAN and right now specifically in Vietnam. So thanks for joining us, David.
Thank you.
So first of all, 93.1% of your portfolio is now in the Vietnamese economy. Yeah. Could you please tell us why this makes sense for you right now? Because exactly, there has been a recession in 2011. How are things going?
Yes. Well, the recovery is going extremely well. The growth rate is accelerating. In fact, we forecast over the next 5 years combined growth in the economy of about 40%. So it will be one of the best growing economies in the world. It is the last economy really to come out of recession relative to other Asian nations. So therefore, the companies are on a low earnings base, firstly. And secondly, it's a market that's very much under-owned globally. And we see that, of course, changing over the next few years. So relative to other Asian markets and many other markets around the world, which are on high earnings bases, that have been in recovery mode for more than 15 years, many of them. And secondly, they have become favourite destinations for capital from investors. So we feel that they're over-owned and there's a lot of hot money relative to Vietnam. So Vietnam, as we're going into a global rate tightening cycle, we feel that Vietnam offers some great characteristics to offer a bit more insulation against what's going on in the global picture.
Because generally analysts see Vietnam as as part of the less developed country group in ASEAN, and that shies a lot of investors away. But that is exactly what deep value investors want, isn't it?
It is absolutely. We see actually a moderation of all those negatives over the next 5 years as Vietnam integrates fully into the Asian common market environment. So therefore, that discount is going to actually shrink materially through 2018.
And in terms of sectors, what are the sectors that you are involved in at the moment that make sense?
Okay. The first stage of the recovery from, let's say, 2012 through 2014, it was very much focused on non-durable goods companies, and they have revived very well. The second phase of the market recovery is about durable goods and services, such things as real estate, construction, building materials. These at the bottom were trading, we believe, as a group, at about 90% discount to long-term intrinsic value. So the margin of safety was extremely favourable as an entry point. Today, they're starting to move as the volume and price recovery in their individual sectors come back into play. So they're still down, though, at least 75% compared to long-term intrinsic value. So we believe this grouping has the most potential upside over the next 3 years.
So as of now, you're focusing on real estate construction, which I guess is in line with the Vietnam also economic model of reconstructing the country.
Yes.
In terms of deep value investment, I mean, in order for it to work, you need significant primary research in the companies that you want to invest in. So have you had any challenges, faced any challenges in Vietnam?
Through mid-2011 through to the end of 2013, we visited over 100 companies. We still did not get to visit 35% of our target list. And 40% of those 100 companies, no other investor had seen for up to 3 years. So there was massive inefficiency, which we believe, was a perfect opportunity to take advantage of.
And in terms of when you look at Vietnam's capital markets, they still are facing a lot of structural adjustments. For example, they still need to organize a bond ratings agency, a commodities index. I mean, Is this a limitation for you as an investor?
Absolutely not, because we see an evolution. We're investing for the recovery, which is already well entrenched. We're investing for the integration into the Asian market. So therefore, these were all the positives. I can name an extra, the merger of the two exchanges. Yeah, there's a discount in stocks listed in the north versus the south, which means that you overweight the north as it gets merged into the southern exchange. So all these are actually advantages over the next 5 years.
And again, in terms of the portfolio, so again, there's a lot of focus on Vietnam.
Yes.
Do you think you will be looking at other ASEAN markets going forward, and what are the favorites?
We take an active view within Asian markets per se. Of course, we have our core portfolios within the Asian markets. At this point in time, we see overvaluation, we see high foreign ownership, we see a high earnings base. These three factors generally mean that there is a reasonably high degree of a pullback or derating in valuations, particularly as we go into an increasing interest rate environment in the US. So at best, many of these other markets like Indonesia, Philippines, Thailand, Malaysia, will at best hold their own in the next couple of years. At worst, you could see 20% corrections.
Perfect. So I guess, even though ASEAN still offers a wide-ranging set of countries at different stages of development, which I guess is perfect for these kinds of investments. Thank you very much for joining us.
Thank you for the time.